Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Rocket One, formerly known as Hoth Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market-structured tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it, at no extra cost to you.
So imagine a company that spent, the last several years running clinical trials to cure skin rashes, and then suddenly they decide they're going to build the next generation of quantum artificial intelligence microchips.
I mean, it sounds completely crazy.
It really does. But, well, today it is actually happening. We are witnessing this sweeping corporate transformation right in front of our eyes.
Yeah, it's honestly a fascinating pivot.
Today is May 28th, 2026, and we are looking at a clinical stage biotechnology firm, formerly known as Hoth Therapeutics. They are completely shedding their old identity, just dropping a legacy name, and aggressively entering the AI, semiconductor, and spintronic computing space.
And they're doing this under a brand new ticker symbol, right? RKTO.
Exactly.
Yeah.
RKTO. It is a remarkable evolution. Frankly, you rarely see a management team attempt to leap from clinical biology into the notoriously cutthroat world of AI hardware.
Right, because those are two wildly different industries. But that is exactly what Rocket One is executing today. They are leaving that biotech moniker behind.
They are aligning themselves with what is unarguably the most powerful macroeconomic trend in the equities market right now. AI is just consuming everything.
It really is. But it's a colossal leap. And frankly, building these advanced semiconductor chips is going to burn a hole in their wallet.
Oh, absolutely. Which naturally leads us to ask how they intend to pay for it without destroying themselves.
All right, let's move into the wealth building context.
Yeah, because if you are managing a long-term portfolio, you have to ask yourself how a radical shift like this actually fits into your broader investment strategy.
Right. From a purely analytical standpoint, what we're looking at here is a dual-pronged moat. It's a highly unusual corporate structure.
It is unusual, yeah, but strategically sound. I mean, they aren't just taking a blind leap into the dark with no safety net.
No, they have a foundational floor built on their biological assets. Let's break this down practically. Think of it like a real estate developer.
Okay, I like this analogy. Imagine a developer who owns a highly regulated, very steady, specialized medical park. That medical park is their legacy biotech foundation. It protects their downside and holds intrinsic tangible value.
Right. It's a real physical asset with established worth.
Exactly. But instead of just resting on that steady property and collecting rent, they are using the stability of that asset to fund the construction of a high-risk, high-reward, futuristic skyscraper right next door.
I see. And that skyscraper is the AI semiconductor play. It's their aggressive attempt to build a permanent technological moat.
You got it. And the internal architecture of that specific skyscraper is what makes this so compelling for investors.
Yeah, because they aren't just trying to build another standard silicon microchip to compete with the established legacy giants. I mean, that would just be financial suicide.
Completely. They'd be crushed in months.
Right. Instead, they are targeting a technology called Spintronics. For those of you tracking the AI sector, you know that traditional silicon chips are hitting a physical wall right now.
A literal physical limitation, yeah. Standard chips process data by moving electrical charges, literally pushing electrons through microscopic wire.
And that physical movement creates friction. And, well, that friction generates an enormous amount of heat.
And that heat is the absolute primary bottleneck for AI data centers right now. It requires an incredible amount of energy and water just to keep those legacy servers cool enough to function.
Precisely. But Spintronics represents a fundamental leap in physics. Instead of leveraging electron charge and moving things around, Spintronics leverages electron spin.
Wait, so it's not moving the electron at all?
Exactly. It utilizes the quantum magnetic state of the electron, basically flipping its orientation up or down right in place.
Wow. Okay, so because you are just flipping the magnetic state rather than physically moving an electrical charge across a medium, you require drastically less power.
Drastically less.
Mm.
And you generate virtually zero heat. It is a profound leap forward in AI processing power and energy efficiency.
So, if Rocket One successfully commercializes this spintronic prototype, they are establishing immense switching costs and intellectual property barriers.
Absolutely. If that technological skyscraper gets built, it completely redefines the landscape. But obviously, constructing that kind of hardware takes serious capital.
Which brings us to the balance sheet. Now let's look at the fundamentals, because we have to see if the math actually supports this massive ambition.
Right. Let's look at the reality of their cash position.
Historically, as a clinical stage biotech firm, their commercial revenue has been essentially zero. They have relied heavily on milestone payments and grant capital.
Which is pretty standard for the industry, but it means cash is tight.
Very tight. It's the standard operating procedure for biotech, but it also dictates that the balance sheet must be managed with absolute precision. You cannot afford operational bloat when you do not have a recurring revenue stream.
Which brings us to the latest numbers. If we look at their Q1 2026 earnings data, we see an earnings per share, or EPS, loss of 17 cents.
Now, on the surface, a loss is a loss, right? But context is everything here. That 17-cent loss is actually a substantial 37% year-over-year improvement.
Yeah, compared to the 27-cent loss they reported in the exact same period last year. So they are cutting costs effectively.
They are. However, looking at this objectively, I have to flag that free cash flow remains negative. They are burning cash on R&D for their biotech assets.
And they are simultaneously preparing to allocate heavy capital toward this new AI chip research.
Exactly. So how is that sustainable? I mean, how do they survive that double burn?
I understand the concern, but we have to reframe how we view negative free cash flow in this specific context.
Yeah.
When a company is undergoing a transition of this magnitude into high-tech hardware, you do not want them hoarding cash for share buybacks or tiny dividends.
Right. That would be counterproductive to the pivot.
Exactly. You want them aggressively reinvesting for exponential growth. And that shrinking per share loss, that 37% improvement, is the key indicator here.
Oh, it shows serious capital efficiency.
Yes. It proves that the management team knows how to stretch their cash runway. Shrinking the cash burn rate is the exact financial discipline a company needs to survive the valley of death between semiconductor research and commercialization.
That makes perfect sense. The efficiency basically buys them the time they need. That brings us to the catalyst timeline.
And this is where things get really immediate. Because today, May 28th, 2026, is ground zero for this transition.
The official ticker change to RKTO goes live today. And mechanically speaking, for those of you trading the markets, a ticker change is not just a cosmetic update on your screen.
No, not at all. It triggers a massive wave of algorithmic and index ETF rebalancing.
This is a crucial point regarding market mechanics. When the symbol updates across the major exchanges, institutional passive funds, automated market screeners, and sector ETFs are mathematically forced to adjust their holdings.
Right. If an ETF tracks a specific index and a company inside that index changes its structure or ticker, the fund's algorithms automatically buy or sell to match the new weighting.
Which forces fresh, indiscriminate buying pressure and creates immediate visibility on institutional radars.
And that is just the immediate near-term event happening today. We also have an upcoming Investor Day in the calendar.
Oh, right, where the company intends to formally debut these Spintronic AI prototypes.
That is the moment the market will finally see the quantifiable physical roadmap for the new brand.
But as we focus on the chips, we really cannot ignore the legacy biotech catalysts happening in the background. They just secured regulatory clearance in Spain for their HT001 phase 2 clear trial.
And we should definitely unpack why that HT001 trial matters. This is a treatment for severe skin toxicities caused by EGFR inhibitors.
To put that in plain English, EGFR inhibitors are incredibly potent drugs used in cancer treatments. They target specific proteins to stop tumors from growing.
The problem is our skin relies on those exact same proteins to regenerate and stay healthy. So when a patient takes these cancer drugs, it severely attacks their skin as a side effect.
Yeah, causing debilitating rashes and painful infections. It is a horrific side effect. And historically, if the rash gets too severe, doctors have to pause the life-saving cancer treatment just to let the skin heal.
Exactly. And that is where HT001 comes in. It acts as a localized shield. You apply it topically, and it treats the skin toxicity directly without interfering with the systemic cancer drug circulating in the patient's body.
That's amazing. So the data from the trial showed meaningful patient reductions in those toxicities with absolutely zero treatment disruption.
Right, the patient's got to stay on their cancer meds. So this foundational biological asset is actively achieving clinical validation in Europe.
That is an incredible medical breakthrough running entirely in the background of a semiconductor play. And that clinical validation coincides with broad macroeconomic tailwinds.
Very strong tailwinds.
Yeah.
Right now, we are seeing a wider market rotation out of lagging biotech indices and into premium AI equities.
Rocket One is essentially riding a wave from a cold sector directly into the hottest sector on the planet. Couple that with the broader macroeconomic environment, specifically the Federal Reserve, and the potential for rate cuts.
Right. Rate cuts are a massive catalyst here.
But honestly, I hear this all the time, and it can get confusing for a lot of people. Why would a potential rate cut help a cash-burning tech startup more than, say, a solid dividend-paying company?
It's a great question, and it all comes down to how institutional analysts model valuation. When Wall Street values a growth company like Rocket One, they build what is called a discounted cash flow model.
Okay, a DCF model. So they are acknowledging that the company isn't making big profits today.
Right, but they might make billions 5 years from now. To figure out what those future billions are worth to an investor today, they have to discount them by the current interest rate.
Because a dollar today is always worth more than a dollar tomorrow, right? Especially if you can just put today's dollar in a risk-free savings account and earn interest.
Exactly. When interest rates are high, say at 5 or 6%, you heavily penalize those future cash flows. They're worth much less in today's terms.
Oh, I see. But when the Federal Reserve cuts rates, that discount rate drops.
Suddenly, the future revenues from a breakthrough Spintronic chip become significantly more valuable on today's balance sheet.
Wow. So established value stocks, which are already generating cash right now, don't get that same explosive mathematical lift from a rate cut because their value isn't locked 5 years in the future.
That is a perfect breakdown. That's exactly why growth stocks soar on rate cut news.
Now let's pivot to the chart, because the price action leading up to today has been incredibly telling for anyone watching the tape.
Oh, absolutely. A biotech to AI rebrand is a profound psychological catalyst for the market.
And we saw that psychology play out violently on May 27th, the day before this official ticker change. We saw a dramatic breakout from a long period of low volatility consolidation.
The stock suddenly hit major market scanners everywhere. It appeared on lists for 12 healthcare stocks moving and dominated the most active stocks screens across retail brokerages.
That kind of sharp intraday price movement paired with a massive volume surge is a definitive signal, isn't it?
It clearly indicates institutional repositioning. You have algorithmic trading flow and heavy retail momentum actively front-running the ticker change.
Because momentum traders specifically scan for unusually high volume.
Exactly. When they see a stock breaking out of a tight, boring consolidation phase, right as it announces an entry into AI semiconductors, it acts like a magnet for speculative capital.
The chart essentially woke up from a coma. So what does market sentiment look like?
If we step back from the technicals and look at the broader narrative, the mood is unequivocally bullish.
Yeah, if you pull the top 5 recent news stories surrounding this stock, every single one of them is overwhelmingly positive.
The headlines are entirely focused on the execution of this premium AI sector entry.
Right, and they're talking about the improving financial trajectory with that 37% EPS gain and the clinical validation of the HT001 trials in Spain. The market is actively rewarding the audacity of this move.
The official news flow is strong, for sure, but beyond the headlines, the underlying rumor mill is spinning up some incredibly compelling narratives.
Okay, I love a good market rumor. What are we hearing?
There is speculative, unconfirmed market chatter right now regarding that legacy HT001 biotech asset we discussed. The rumor circulating on trading desks is that they might spin off or partner the HT001 platform with a major global pharmaceutical company.
Okay, here is where it gets really interesting, but I have to apply a skeptical lens. The idea being floated is that they would use the capital from licensing or partnering the biotech asset to entirely self-fund the new AI Spintronic research.
Right, and on paper, that creates a dream scenario with zero shareholder dilution. You don't have to issue new stock to raise money.
But is this zero dilution rumor just speculative retail chatter, or is it a legitimate strategic possibility?
I mean, it is technically speculative, as the company hasn't confirmed it, but strategically, it makes perfect logical sense.
How so? Walk me through the pieces on the board.
Well, if you are holding a scientifically validated biotech asset that just received regulatory clearance in Europe, that asset has tangible, immediate value to a large pharma company.
Because Big Pharma already has the global sales teams and distribution infrastructure in place.
Exactly. They just need the validated product. By monetizing that legacy asset, Rocket One could inject substantial, non-dilutive capital directly into their semiconductor R&D.
Which would solve the absolute biggest hurdle facing any tech startup. How do you fund the initial hardware fabrication without destroying your shareholders' equity?
That would be a masterstroke if they pull it off. But we can't just look at the upside.
Right. Now let's talk about the risks, because we have to address the elephant in the room here.
Yeah, we definitely do.
This is a staggering operational shift. From a practical, boots-on-the-ground standpoint, it sounds absurd. A company that spends its days analyzing biological skin toxicities is suddenly going to start manufacturing quantum-level microchips.
They are biologists and chemists. They have zero established track record in commercial semiconductor design.
That is an enormous execution risk. Furthermore, AI hardware is incredibly expensive to prototype and scale. If that spin-off rumor doesn't materialize, the risk of secondary stock offerings and severe capital dilution is extremely high.
You are entirely correct to highlight those structural risks. Developing advanced hardware requires specialized engineering talent, access to foundries, and heavy fabrication costs. You don't just build a Spintronic chip in a garage.
Exactly. So how do they mitigate that?
However, we have to look at the mitigations already in place. First, look at their operational history. Navigating the FDA in the United States and the EMA in Europe is arguably one of the most grueling, complex, and highly regulated processes in global business.
That's true. The red tape is legendary.
Management has definitively proven their ability to push a pipeline through those regulatory labyrinths.
So you were saying that the administrative muscle translates across industries.
Exactly.
Yeah.
Navigating international clinical trials requires an elite level of operational discipline, strict capital allocation, and rigorous project management.
So those are agnostic skills.
Yes, they directly translate to managing the multi-year development cycles and supply chain logistics of semiconductor architecture.
And to be fair to the management team, they have already proven they know how to protect the balance sheet while executing these complex operations.
Yes, that 37% year-over-year EPS improvement is the empirical proof. They aren't just spending wildly on a sci-fi dream, they are aggressively managing their cash burn rate.
That proven financial discipline provides a critical buffer against the exact dilution risks we just mentioned. They know how to operate lean.
Right. So with everything on the table, what's the final verdict?
Based on the research, the macro tailwinds, and the current market dynamics, we are looking at a very strong bullish score of 8 out of 10.
That's a solid rating. The core investment thesis here is asymmetric upside. You have the explosive potential of the AI and Spintronic computing rebrand, fundamentally coupled with the de-risked downside protection of a validated biotech floor.
It is a uniquely advantageous structural setup. The market simply has not fully priced in the reality of this AI re-rating yet.
In terms of a target horizon, this presents an immediate swing trade opportunity to capture the algorithmic and retail momentum of today's ticker change over the next 3 to 6 months.
But if they actually deliver on these Spintronic prototypes at the upcoming Investor Day, this rapidly transitions from a short-term momentum swing into a multi-year long-term hold.
It all comes back to that real estate developer analogy you used earlier. The steady medical property is securing the plot of land.
Exactly, but the real value unlocks when that state-of-the-art technological skyscraper is finally built. Before we wrap up, it leaves you with a fascinating question to ponder.
What's that?
If a clinical biotech firm can successfully leverage its underlying assets to buy its way into the quantum computing revolution, it makes you wonder how many other legacy companies out there are sitting on underutilized cash or quiet assets, just waiting for the right moment to pivot into the AI space.
That's a great point. The market might look very different a year from now.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.